I've been investing for a number of years now, and I've had my fair share of failures and successes, but there is common themes which I consistently see which result in people losing money. And today I'm going to share with you 4 of the most common mistakes that new investors make. How's it going, guys? Ryan here and welcome back to another investing video, and today we are talking about common mistakes that investors make, particularly the beginners, and more importantly how you can avoid them. But before we get into that, guys, please remember to give this video a thumbs up if you do enjoy it, and subscribe for more investing, wealth management, stock market and cryptocurrency content. I'd love to know your thoughts on some of the most common investing mistakes that you've seen in your time on the stock market and ways in which you've been able to avoid them. But without further ado, let's get straight into today's video. Kicking it off with common mistake number 1 that you need to avoid, and this is the biggest issue when it comes to new investors, and that's the fact that they simply do not do their research into a stock before buying into it. And more often than not, I see with a lot of new investors getting into the stock market, they literally have no idea about the company that they're investing in, and as a result, they're putting their money on a stock by purely gambling it because A, they've either been told it's a good stock, B, they've seen some sort of a news article promoting it, 3, they might like the product or whatever, 4, it might just seem like a good investment at the time. But there is still stacks of other reasons as to why people just buy stocks for absolutely no reason that is legitimate at all. You need to do your research when you are getting into stocks, and if anyone is out there recommending you stocks, by all means listen to them, but then make sure you do your own research into those stocks as well. The worst thing you can do is put your own hard-earned cash into a stock and then that stock plummets, and the best way to avoid doing that is by literally doing your research on the stocks and making sure that your investment is solid and understanding the value of that company where it is now and the potential trajectory for that company based on what they are currently doing and their future plans. Make sure you do your research. Don't take advice without doing it and then just buying into a stock. Please remember, this is the most important rule when it comes to investing, but it is also one of the most common mistakes that people make, not doing their research. Common investing mistake number 2, mixing your strategies together. And this is something that I also see time and time again, and something that I've personally done as well, and as a result I've suffered the consequences of it. When we talk about mixing strategies, we're talking about the difference between investing and trading. These are 2 completely different methodologies, and you need to understand that they don't mix well. And if you want to invest and trade in a stock, you need to have 2 separate accounts, and you need to have 2 completely separate, unrelated strategies. Now, let me explain why mixing these strategies are actually a mistake. If you're investing, effectively your goal is to hold onto a stock for probably a medium to long term period. And as a result, you've got certain goals and milestones that you're expecting your stock to hit. What you should be investing on is the fundamentals of that stock, which is what makes that company a legitimate company. What do they do? What's their operations like? What are their costs? All those sorts of things. How do they add value? How are they as a company, and are they going to keep growing and keep making more money? That's effectively your goal when you're investing, understanding these concepts, because that is how a share price rises over time. Now, secondly, if you're talking about trading, what you're looking for is likely short-term trades or swing trades and those sorts of things. Your focus may be slightly on the fundamental side, but that is catalyst based. And instead, you're likely more looking at technical analysis, which is where you're looking at trends on the price data that has occurred for that stock over the short-term period, and you're in and out very quickly, and you've got clear entry points and clear exit points. If you don't have those, you need to put them in place. But what we can see here is the two strategies have completely different purposes. Strategy A, investing, is where you're literally doing your research and buying into a stock for the company, expecting the company to grow. If you're trading, you're just looking to make profit off the short-term patterns or price action or whatever it may be. You don't really care about that company in the long term. Now, the issue comes when your emotions get involved. Typically, what I see is that people get invested in a stock. So the strategy number one is investing. So that's what they do. They plan to hold the stock for X amount of time, and you should be basing your catalyst for buying or selling a stock on what the company's actually doing as opposed to the price action. Then all of a sudden, the stock may drop 10%, and all of a sudden that individual panics, and what they do is they sell the stock for a loss. But fundamentally, the company hasn't actually changed, although the value of that stock has. But they've implemented a trading technique to cut their losses when we're talking about investing over a long-term period. Yet, this is only a daily price fluctuation that has occurred. And as a result, the next day, the stock price actually increases by 30%, for instance, just as an example. And that person, instead of having just held that stock and waiting for the long-term goal to be met, has just lost 10% of the value of the money they invested in that stock in the first place, due to the fact that they are mixing their strategies together. And as I mentioned before, emotions are the main cause of this. And effectively what you want to do is separate your emotions, separate your head from your heart. And therefore, having a clear strategy in place where you either invest or you trade, you can do both, but separately. Clear strategies so you don't get emotional and you don't lose money unnecessarily. Another example of this would be if someone's trading a stock, they're looking to get a quick profit and they've got a price target, an entry and exit, and then what happens is it hits their price target, but they've been holding the stock for a week, they've been reading up on it a bit, and they've decided, oh, this company might be a bit interesting. But what they're doing then is getting emotionally involved once again, and they think, oh, I might hold on to this for a bit longer. It actually looks like a decent long-term hold. But then the price plummets, and all of a sudden they lose their profits and they're back to square one or even less. And they go back to that trading mentality once again and go, oh no, I need to exit now. Whereas before, they could have hit their price target, made a profit, and been done with it. Don't mix your strategies, guys. This is a common mistake that you really need to avoid. Common investing mistake number 3, going all in on a stock. This is one of the riskiest moves that you can make when you're investing in the stock market, particularly when you're talking about investing large quantities of money. So going all in on a stock basically exposes you to the risk that this stock may be affected by so many different factors that result in you either, well, yeah, potentially gaining a lot of money, but also potentially losing it all. If you effectively put your whole portfolio into a single stock and that stock drops, what you're going to see is the potential for your portfolio to just crumble very, very quickly. If something goes wrong, that will result in you losing a lot more money than if you spread the risk across 2 or 3 stocks, for example. So make sure you're not putting all your money into one stock. It's just exposing you to way too much risk. And as a result, I see lots of people, and I've seen it plenty of times, where a stock is going absolutely crackers, going up, it's pumping, and then you get a lot of mum and dad investors seeing it on various websites, news articles, all those sorts of things, and they go and put, 40 grand into it, and it's all their spare capital that they want to invest, and it's all on that one stock. But it's a pump, and as you know, what happens with a pump? Well, it's followed simply by a dump. and all that money disappears like that, straight into thin air. So don't do that. Don't go all in and put all your eggs into one basket. Make sure you at least have an element of diversity in your portfolio. Even if it's only a few stocks, that is fine. It decreases the risk you're exposed to significantly. The fourth and final investment mistake that I'm going to talk about today is one which has trapped me, and this leans more towards the trading side of things if you're investing maybe for a medium-term period and you're not looking to stay in that stock more than, I suppose, a few months. And that's effectively buying into illiquidity. So effectively, liquidity in the stock market or in a stock is your ability to enter and exit that stock quickly. So a liquid stock has many buyers and many sellers and many shares. So effectively, consistently, people are buying and selling shares on a very regular basis. It's very easy to either acquire new shares or sell new shares. Effectively, it should be at the drop of a hat and there won't be much resistance there. And when you do buy or sell your shares, it shouldn't be in a vast difference from the actual market price at the time when you're looking at it versus what you acquire it for or what you sell it for, due to the stock being liquid. An illiquid stock is where you have no buyers, no sellers, or potentially you might have one of each. So you might have a lot of buyers, not a lot of sellers, or a lot of sellers and not a lot of buyers. And what I see a lot of people do, and what I have done personally myself, is get stuck in a stock. So for instance, a lot of micro cap stocks, you'll notice they actually exist under 1 cent, particularly when we're talking shells. And as a result, you have massive buy stacks on the buy side, but then the volume on the sell side is relatively limited. And effectively what that means is people are pressuring to buy up, or you've got the opposite scenario. You've got lots of buyers, but then, I apologize, lots of sellers, but not many buyers. So you're looking to exit that stock. And effectively what you're going to have to do is dump it at whatever the price is. There's no way for the price to actually rise over time. So basically, you want to make sure you don't get stuck in these liquid stocks and stuck in a position where you've either overbought too many shares and it's hard to get rid of them on the market, or potentially even buying into a stock which just has no movement whatsoever. Many stocks trade sideways and don't fluctuate in value, but if you buy too many of these stocks, you cannot exit quickly. Particularly, as I mentioned, you see this in the micro cap realm because there's lots of shares on issue. All of a sudden you get a little announcement which isn't actually too bad, or it might be pretty bad, and effectively people are dumping the shares, but nobody's buying them because it's not one of those blue chip companies where you're consistently, going to have investors wanting to buy your shares, and all of a sudden the buy side just completely dissipates and all you've got is sellers, and you have to dump your shares at whatever price it is or hold on to them, and likely it's going to be for a loss, and it's going to be a long time if it ever gets back to the break-even price. So make sure you don't overbuy when it comes to stocks which are illiquid. And that wraps up today's video, guys. 4 common investing mistakes that you should avoid, particularly if you're a beginner. Some of these are massive traps which I've been caught in before and I've lost money in as a result. So please learn from my mistakes and avoid these situations. If you did enjoy today's video, please remember, give it a thumbs up. Helps me out so much, and subscribe for more of this type of content. We do wealth management, stock market videos, cryptocurrency, all that sort of cool stuff. And I'd love to know your thoughts down in the comment section below. Have you been caught in any of these similar sort of situations? What are some other common investing mistakes that you recommend other people try to avoid? And with that, guys, I hope you have an awesome day. I'll see you next time. Cheers.